Welcome back, traders and investors. This is Joel Elconin on the Pre-Market Info Show, and we are lucky enough to have on a special guest again, Tim Melvin of the Deep Value Ladder. Tim, how you doing today?
I'm doing great. Thanks for having me on again, guys.
Right. Okay. Well, the market is continuing on its merry way here, busting above the 1764 level, which was a triple top here. But over the last couple days, we've been talking about some rotation, and at the end of last year, a lot of money started to pour into some of the lower price, just beat up stocks. Uh, Best Buy, Hewlett Packard, and those stocks just had some tremendous runs, this year. You can't argue with it. And now we're starting to see some of the same things. So you take a stock like Alcoa here, gets kicked out of the Dow, and now it's coming to life. Do you have an opinion, or do you follow that stock, or what do you think of Alcoa?
Well, I liked Alcoa when it was a lot cheaper. It started to move up. It's out of where I would buy it, but when it was trading down below book value, I certainly had a pretty big interest in the stock. It's a leading aluminum company. It needs a solid economic recovery to really rebound. But you've got an awful lot of money out there looking for cheap stocks, and that pool of stocks is getting thinner and thinner and thinner. So now it's starting to flow into some of the material companies like Alcoa, betting on a long-term economic recovery.
You mentioned, I don't want to throw you under the bus here, but you mentioned book value on it. Just off the top of the head, do you have book value on that, or
Oh yeah, let's see here. Book value is about $11.96 of stated book, and if memory serves, there's right around $8 of tangible book here.
okay, so even though it's trading at 985, that's not far away from the book value to draw your interest. You like to
It,
see it farther away from the book value or the tangible book value?
it has to be below book value for me to be a buyer.
Okay, all right. Another one that's coming off the mat here, J.C. Penney, made a low at 6.25 lately. Now it's kind of trying to get back above the 850 level. Is this draw your interest yet, or is this just still too much negativism in this stock?
Well, it's not just the negativism in the stock. It's the fact that when you go through and start to look at their balance sheet and what this thing is actually worth, they have a book value of $10, but they have a negative liquidation value. And business is just horrible at this company. If you walk into a J.C. Penney's, um, it's almost like they don't know what they're doing in the stores. And I don't see the business recovering. The stock's going to go all over the place because different large pools of money are going in and out of it. But I don't think the business actually has much of a future.
Okay, and then just the last one. This stock has been a laggard for years here. AMD. I mean, is that stock on your radar at all, or is it just not enough? Not enough fundamental analysis to support being in this stock.
Actually, this stock just showed up in my list of long shots. That stocks where if they recover, they're going to go up 300 or 400%. If they don't, you're going to lose a few bucks. But long term from this price level, AMD probably has a future. Now, they've got some new products. They're trying to compete again in the marketplace, and I kind of think they might be successful here.
Okay, they've. I'm just looking at it from a technical perspective here, and we've been between 330 and 340 here for the last couple days. So a little bit of consolidation. Maybe if you get above that 340 level, get a little bit a move on the upside. So we talked about the lead, the laggards here and the leaders. Now something like Facebook that doesn't show up on your radar, right?
No, no, that's stocks like Facebook, LinkedIn, Netflix, Tesla. I call them betting slips because that's really what they are. They're betting slips in a popularity contest. You certainly can't value them as a business at this price level.
Okay, I noticed when we were exchanging emails back and forth about the show today, you said discussing market levels. Now, I'm a market level junkie here, and I probably do too many levels. So, could you just give us a quick update or what you look at for market levels? Are you looking at daily charts, or do you get fancy with your technical analysis with stochastics or MACD? What exactly do you mean by market levels?
The only thing that I look at in the market, because I am the worst market prognosticator of all time. There's nobody worse than me at predicting what the market's going to do in the short run. What I look at is the number of stocks that fit my deep value criteria. As markets go higher, that list gets shorter and shorter and shorter. And over the years, and I'm getting to be an old guy now. I've been around doing this for more than 25 years. When that pool of stocks gets down to where it is today at 25, 30 stocks that fit the basic criteria, you're toppy.
Okay. Okay. Good. That's a good explanation without going into deep detail like we do here sometimes. What about the consumer staples? We had Matt McCall on yesterday, and he was discussing some of the consumer staple stocks, with their stable dividend and things like that. But he kind of talked about that as stocks that he would kind of be avoiding right now. That a little bit overvalued. You get stocks like Procter and Gamble that had a huge run. Johnson and Johnson's just had a major run here too. Where do these stocks fit in on your radar?
It's funny because I just wrote about all these not too terribly long ago. When you put these through a basic analysis of the business, what's the business worth? And I have a model that I use to compute what I call the intrinsic value of a business. That's usually the price where I'm selling a stock. That's the full fair value of the business. These stocks universally, Clorox, Procter & Gamble, all the consumer staples, traded at least twice their business value. I mean, it's real nice. They've got those nice, comfortable dividends, and it's a great name, Procter & Gamble. You know it. You've got a house full of their products. But the stock is ridiculously overpriced relative to its value as a business.
Wow, that's a very interesting comment there. I think I'm going to take a note down on that, and maybe I can get my J&J puts to come into the money. Maybe I should have played the weeklies. Maybe I should go a little bit farther out. But that's a little bit that's interesting analysis here.
Yeah, don't ever play the weeklies on anything that I suggest, because my time frame is it's pretty far out there.
Well, actually, I don't say that. I wasn't the recipient of it, but ahead of earnings, I can't get the symbol up here. You had mentioned Cliff's Drilling last time. Do you remember that?
Yeah, sure.
And Dennis played that into the earnings here, I believe, with the 25 and the 26 calls. And, I think that he did okay on them. But now that stock is made a nice run up towards the $29 level, double top at 28.96 and 98. Does that? Are you still sticking with that on your model?
Sure, I still own it. The full value of the business is about 35, and I'll start selling if we get to that. And this is an example of what I talked about earlier. This stock has gone up a lot faster than I ever thought it would when I started buying it. But there's a lot of money out there looking for a home right now, and they're rotating away from the larger blue chips and even the tech stock momentum stocks because they've run so far. So you've got these enormous pools of mutual fund and hedge fund and the regular institutional money, and they're starting to bottom feed a little bit.
Okay, that's what we like to do here. We like to find some value in the stocks. What about the banking sector here? I've noticed a couple stocks have just been in a holding pattern, like a stock like Wells Fargo here. I mean, been talking about this on the show with our traders, trying to get a breakout between 42.5 or 43. Are you looking at the banking stocks here? Perhaps when they start to taper and interest rates go up, is there any bank stocks of interest?
Yeah, but I don't really care too much about the bigger bank stocks, except Wells Fargo. Now, we own a lot of that in my wife's 401k, so I think all you guys should run out and buy tens of thousands of shares and just push this thing as high as it can possibly go. But my real interest is in the smaller banks, the banks with less than $1 billion in assets, the little 5 and 10 branch banks that are literally all over the country. These things are trading extremely cheap right now based on their tangible book value. And In the aftermath of a credit crisis, we saw this in '98. We saw it in the aftermath a little bit of 2003, and certainly after the S&L crisis back in the late '80s, early '90s. You get a consolidation wave that just rolls through these things. And you're buying them at 75, 80% a book, and the eventual takeout price is going to be 1.5 to 2 times book. And it lasts for a very long time once the wave starts. It's just starting. And we're starting to see small banks get taken over and merge.
Could you just give a few examples of those? I'm not sure if KeyBank KeyCorp fits that criteria. Just give a few examples.
Sure. And I should have sent you the ticker. I'm sorry, I was filling my coffee there. But HFBC, HopFed Bancorp. If you take this, is what's the market cap on this thing? It's pretty small. But you've got a bank located in Kentucky, Hopkinsville, Kentucky, that booming metropolis. Stocks trading at about 70% of tangible book value. These guys have underperformed badly. The return on equity and assets has just been horrid. But they decided they were going to buy an even smaller bank in the neighboring state of Tennessee. This attracted some activists into the stock, most notably Joe Stillwell of New Jersey, who's been around a long time doing this small bank stuff. And they bought a lot of stock, and they called management and said, look, you guys are idiots. You're not doing that. And management tried to resist the New York boys for a little while, but they lost. They gave up their bid to buy the other bank, doubled the dividend, announced a 5% stock buyback. And, Stillwell and the other guys have not gone away. They're trying to force a sale of the bank.
Right, so these little banks do pay dividends, huh? So that's kind of like an extra bonus, to protect your equity a little bit. If you get a little bit of decline, you could still get dividend. I wasn't sure all these smaller banks did pay a dividend, but...
Well, a lot of them cut their dividend or eliminated it during the credit crisis, but most of them do pay dividends, because if you think about who their shareholder base is for the most part, it's the guys, the business people in and around the town that they operate in, and they want a dividend. That's why they bought the stock. So this sector is actually going to be one of the great dividend growth stories on top of everything else, because as credit conditions are stabilizing, they're reinstating their dividend, and you're going to see them raising it rather rapidly over the next 5 years. So in addition to all the takeout potential, I think you've got a really solid dividend growth story in the small banks.
And do you do anything with these smaller banks? Do you look at anything like on a regional basis? Perhaps a country or a state like Michigan, which is had a depressed economy well ahead of the rest of the country now, with the auto industry turning around. Do you anything regional based where you have a little bit more of a bias, or you just strictly go with your models and your numbers?
Yeah, we go with the models. Like the Michigan thing it's a fun story to talk about, and there are some opportunities, because you think Michigan, you think, oh my God, Detroit, it's horrible. It's business is bad. They play hockey there. I mean, it's just not a great place to be. But the western part of the state is actually growing a little bit faster than the rest of the country. So there's some opportunities. But when it comes time to buy, everything spins off of tangible book value, the loan portfolio, and how much equity they have in the bank.
Okay, you also mentioned shipping stocks. That might be on your radar here over the next couple weeks or so. What any particular shipping stocks that we should alert our investors and traders to? Sure,
but keep in mind, nothing is on my radar screen with a time frame of a couple weeks.
Okay.
Except for the fact that there's a little more than 20 weeks left till spring training starts. I measure stuff more in months and years. But shipping stocks is, this is a follow the money game, okay? Shipping has been a horrible business for the last 5 years. And it's one of those businesses where there's a real pronounced boom bust cycle. And when it's booming, as it was from, say, 2003 to 2007, guys buy too many ships. They think the market's going to expand forever. They think that they're the smartest, best shipper that's ever been in the business. So they're going to expand and put everybody else out of the game. What happens is they put themselves out of the game, basically. We've already seen a couple bankruptcies in the sector over the last year. The overcapacity is slowly working off. New orders are slowing down, and some older ships are getting scrapped, both in the dry bulk and the petroleum shipping side of the equation. But they all trade at not qualify that all, most of them trade at ridiculous discounts to book value. And then you look out there and you see that all the really smart private equity and distress money are making shipping deals. Howard Marks of Oak Tree just did a shipping deal. Wilbur Ross has been in the sector for a couple years now. Apollo, Kohlberg, Kravis, and Roberts, BlackRock. Just about every major distressed or private equity firm is putting their 5 to 7 year money into shipping in a big way. That really gets my attention because that's kind of the time frame I'm working on, and these assets are ridiculously cheap. We're paying 40 and 50% of book value in some instances for that. These are valid businesses that have survived the worst of times. There's an enormous amount of money to be made here, but you're going to have to be real patient, and you might find somebody that actually knows how to read a chart, because I don't,
Okay.
and help you time your entries and movements in that sector. When these things start moving, these stocks are going to double and triple pretty much at a minimum.
And dry ships, is there any other, I'm trying to search here for some symbols besides DRYS. Is there another symbol?
Sure. SBLK is an interesting name that I just added to my international portfolio. That's Star Bulk Carriers. They are actually buying some more ships. Business is okay. They're anticipating an increase, but they just did a stock offering to pay for the 9 new boats that they ordered. I'm sure somebody's going to yell because I said boats instead of ships, but this is a deal. Howard Marks and Oak Tree walked away with over 21% of the company after the offering. Now, Howard Marks is one of the smartest guys on the planet at finding distressed assets with recovery potential. 90% of the time, he invests through the debt side of the equation. When I see him buying something at 40% of book value on the equity side, I'm going to go get in line right next to him.
Okay, no, yeah, that's good. You follow your analysis, and then you also follow the major players on the street and what they're doing. You made, to close out the conversation here, you made an interesting comment to me, and you said that that right now your pool of stocks that you're following and that fall into your models and your criteria is down to 25 or 30. I'll make this a two-part question. One is, what's been the extreme end on the other end, perhaps during the financial crisis? I mean, was there 2, 3, 400 stocks that were fitting your criteria? And also, have you done any kind of comparison of when your pool of stocks gets to these low levels or really extreme levels? Is it any kind of an indication for a turn in the market?
Okay, on the other end, to give you an example, in late 2008, there were 100 stocks below book value just in the S&P 500. Okay, we probably had a pool of names that fit the model and passed the credit checks of a little more than 200 stocks. I'd have to go back and pull the records, but close to that. And in 2003, the pool was just ridiculous. We had a couple hundred stocks trading below their cash value, never mind their book value.
Okay.
So there could be a lot of stocks. And have I precisely measured what happens when the pool gets down to this size? No, I haven't. But I can tell you that this thing's at levels of that deep value opportunities that feels very 2006-ish, 1999-ish to me. The numbers are roughly the same as to the number of cheap stocks. It concerns me, I have to be honest, because although I'm not a market timer, in addition to the low level of opportunities, Warren Buffett calls the market fairly valued. Icon calls it overvalued. Sam Zell said it's like real estate in 2006. Seth Klarman just flatly said when they stopped tapering, we're going down 30%. These are really smart, really rich guys who have been around a long time. So when I couple that with the fact I can't find anything to buy that's not a small bank, this market makes me really nervous, and I don't usually get nervous about markets.
Okay, that's wow. What a great synopsis here of those two questions I put in front of you. We are fortunate enough here to have Tim Melvin on of the Deep Value Letter, and giving us some interesting analysis here, fundamental analysis, tangible book value, real book value, cash value, all the things you investors should be paying attention to. So, Tim, what a great interview. Thanks for all this information, and we hope to have you on again soon.
Thanks a lot, guys. I love coming on. I really appreciate the opportunity to talk with you guys.
Okay, have a good day.
All right, thank you.